Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Last week was the fourth week in a row that the Nasdaq-100 was down more than 3%. Joining me to discuss how it historically performs and if a relief is in sight is Russell Rhoads, Director of Research over EQDerivatives. Russell, it's great to see you. As always, welcome back to Trade Talks. And as you love to do, let's dig into the streaks and tell us what history says about this kind of performance here.
Absolutely. Not exactly the kind of streak that you really want to talk about. But as you mentioned, it's a rarity that the Nasdaq 100 has gone down more than 3% 4 consecutive weeks. In fact, it's only happened 3 times in the past. So I decided to dig in, and there are the numbers. And the most encouraging part is that 1 week return after this happened twice in 2001 and then back in 2009. I think that 2009 week was when the stock market completely bottomed out, and then we took off to the upside. But I just took a look at what happens after we get 4 of these in a row. I started to pay a little bit more attention when we had 3 in a row, which has happened a couple more times, but 4 in a row is the limit. And if it happens again this week, it'll be the first time that the Nasdaq's been down 5 weeks in a row.
And Russell, I guess the question is, how do you trade this kind of activity?
Sure. So I know the market's moved a little bit since I priced these out, but this morning I took a look and the Nasdaq was kind of unchanged. It was flipping back and forth between red and green. So I priced out some options, and the first trade that I came up with, I took a look at that 3.49% gain, which was the smallest 1 week bounce after we had that 4 weeks of down 3% in a row. I took a look at buying the 12,800 call that expires this coming Friday on May 6th, and then selling the 13,300 call, which also expires on the same day. I picked that 13,300 number because that's very close to about a 3.49% rise from where we finished last week. Cost $210 to put one of those on. Will give you a profit of $290 if we're up at least 3.49%. As a reminder, we do have smaller contracts that can be done pretty much for the same risk reward, but at a much lower price using XND options. And when I priced it out with XND options, everything was pretty much the same, just a smaller dollar amount to work with there.
And Russell, what if you think it's like 2009 and that we could get this, big move up to the upside here?
Well, I felt like a 10% move in a week is a pretty bold prediction. If I said it and I ended up being right, I'd be a genius. If I ended up being wrong, people probably would have ignored it. A lot of people have staked their careers on making really bold calls like that. So what I did instead was I took a look at the average of those 3 occurrences and came up with about 7.9%, which gets us to about 13.8. Now, when I looked at 13,800 options, you could only sell those calls, the May 6th 13,800 calls, for $20 each. And that didn't offset the cost of the $1,280 or $12,800 strike calls enough. So I was like, well, let's see what happens if you sell 2. And if you sell 2, it reduces the price, the 1-by-2 ratio spread. The cost is 290 points. If we're right at that 13,800 point at the end of this week, the spread would profit by 710. And also, just if we overshoot, to the upside, Nasdaq 100 has to go up 13% this week to realize losses on the upside of that payout diagram. So I feel pretty safe about that 1-by-2 spread and not getting hurt on the upside there.
All right, Russell, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.